Now, the name of the unit is Mechanics of Investment. It is Unit 4 of Financial and Management Accounting Paper 10, and it has got 20% weightage. So you may be asked theory questions for sure. And as I have mentioned previously, that at MCOM level, they expect that you write proper answers to the theory questions. Okay. So one thing you need to do is understand it and then prepare properly all the theory topics that you study in all the accounts, right? You must have noticed yourself, if you were preparing theory well and you have written it nicely, you could have scored good marks in accounts, in theory topics as well. And if you were not preparing theory questions properly, then it would have affected your overall marks in accounts. Now, before I start with the topic itself, the mechanics of investment, why we need to learn this topic? See, there are certain topics at MCOM level that they want you to get, that they want you to explore, so that it gives you an opportunity to try and think about making a careers in those areas. For example, having final accounts of insurance companies, or having final accounts of banking companies, or fire insurance claims, or something like that. So you already have some practical topics that gives you an opportunity to understand how the things are done practically, right? So it gives you an opportunity, a chance to explore such areas where you can think of making a career into. But when you have a chapter of on investments, now this is somewhat related to what we did in the last semester in one of the accounts, that is uh, technical analysis and company analysis and everything before you invest, or how the things work in the market. All these things we studied. Now that was from the point of view of understanding and having a knowledge, just in case you want to make a career into such areas. But here in this chapter, we are trying to understand how the investment work, and why people invest, and what is the importance of investments. All such things we are going to understand in this chapter. So as a master's student, as a person who has already uh, is in 20s, you need to understand the mechanics of investment, how the investment works, and how you should put your money into the various investment vehicles, the ways in which you can put your savings, so that it gives you return, regular returns, it gives you appreciation, it provides you liquidity. Whenever you are in need of money, you can just sell any of the investment, you can get the money. You can, so basically you get appreciation on your investment, you get um, regular returns, you get liquidity option, right? And you also get a safety in terms of your money put in proper place. So there's so many advantages that are associated with the investments. So this topic is important from the point of view of any layman. It's not that if you're dealing in stocks and shares, and you have a lot of money, and you have to put it into some fruitful sources, or fruitful investment vehicles, then only you have to study this chapter. This chapter is an important chapter from the point of view of making you aware about when you start actually earning money and you save money, how you can put your money into good places, and what are the factors you need to keep in your mind when you put your money into any investment vehicle. What, as an investor, you need to consider in terms of risk, in terms of returns. So all such aspects that you have learned so far from the point of view of a business or a company, now you need to understand all these points from the point of view of an investor. You being a person who wants to put money to good use, and putting your money into investment, what are the things you should know? All these things are basically covered under this unit. So it will be an interesting topic, because already when you are in fourth semester, and you are always, I mean, you are just about to get into your a real life situation wherein you'll be earning money and you'll be putting your money to good use. So this chapter is going to be very helpful to you in terms of testing your knowledge of investments and returns. And in case you don't have that enough knowledge regarding investment, this chapter will help you to make you smart enough to put your money to the best possible usage, right? So let's not waste any more time. Let us straight away get into the topic. So start with the basics. So what is investment? So the income that a person receives may be used for purchasing goods and services that he or she currently requires, or it may be saved for purchasing goods and services that may that he or she may require in the future. Now this is quite obvious. When you earn income, um, you basically spend money for purchasing goods and services that you want, or in case you don't have money, or you plan that you want certain goods and services to be purchased in future, then in that case you keep the money aside, right? So in other words, income can be what is spent from the current consumption. Savings are generated when a person or organization obtain from the abstain from the present consumption for future use. So what is savings? You generate income, but out of that income, if you control yourself, if you abstain yourself, if you avoid yourself, just a second. So when you try to control your expenditure, you don't want to spend all the money that you've earned in the present consumption, just want to ensure that you have the money for your future use. Now that becomes your savings. And the person saving a part of his income tries to find a temporary repository for his savings until they are required to finance his future expenditure. This result in investment. So we have seen three parts of understanding how investment basically comes into picture. First, a person is earning an income. Out of that income, that person decides to either spend the money for the current requirements in the form of buying goods and services, or if he or she thinks that he or she will need money in the future, then he or she controls the expenditure, you know does not spend all the money which is earned, keeps the money aside. Now this will become saving. And when you put your saving into any temporary uh, way of saving or repository, right, or a place where you can put your savings, this savings, right, that you have made for your future expenditure is nothing but an investment. Okay, simple understanding of how investment comes into picture. So investment is an activity that is engaged in by people who have savings. So first of all, you need to understand that not everyone can do investment. Investment is the privilege of someone who can save money. So when you think of making an investment, the first thing you need to do is to first save money from your income. So investments are made from savings, or in other words, people invest their savings. But all savers are not investors. Investment is an activity which is different from saving. So when you just save money, that does not mean you have invested money, right? Though we can say that saving is investing, but it's like keeping money in your pocket or in your cupboard does not increase your money, does not give you return. So that's not an investment. So investment is something that will, you know, create more value to your money or add value to your savings. It will give returns. to you. That is investment. So it may mean many things to many person. Now here we find a different meaning to different people. Right. So if a person has advanced some money to another, he may consider his loan as an investment. So now you can see how for different person the definition of investment will be different. So when you give loan to others and earn interest on it, then that savings that you have given as loan to others is an investment. He expects to get back the money along with interest at a future date. For another person, may have purchased a kilogram of gold for the purpose of price appreciation, and he or she may consider it as an investment. So, depending on your viewpoint, what you think as an investor is a good place to put your savings into can become an investment. For example, many of us do consider buying a house as an investment. Many of us also consider buying gold ornaments as an investment. Yes, it is an investment considering the gold values are going up, but actually, if you're buying a house for living into it, it's not an investment. If you're buying ornaments for wearing it as an ornament, if you're buying gold and if you're using only it as an ornament, then that is not investment, because in that case you will not get the money that you have investment in terms of making charges, and all those things will be added to the cost of the gold. So it is not a wise way to invest money. Of course, if you can buy gold coins or gold bars, then that is a different story. But just by, females tend to think that way. Of course, you'll get the money as and when required. It always gives you liquidity. That whenever you are in need of money, your family is in difficulty, you can always go and sell, or you can get loan against your gold ornaments. But it's not a wise way of investing, considering that you don't get the full value of gold, because it's in the form of ornaments, and ornaments always have some other metals, plus when you wear it, then it also adds to or reduces the value of gold. So so depending on your understanding of investment, the definition of investment is always going to change. So basically, investment means a lot upon the perspective of the investor. What investor thinks, or what investor has in his mind as the purpose of investment. Okay, moving on. So let us now try to understand the definition of investment. So investment is defined as the commitment of the current financial resources in order to achieve higher gains in the future. Now, this is a standard definition. You can say this is something you need to keep in your mind when you think about investment. So what you are doing basically is you are going to consider your current financial resources. You're committing your current financial resources in order to achieve higher gains in the future. You're going to get something more than what you're putting in right now. That is the crux of investment. If you're getting more than what you're putting currently, in the future, if you're going to get more, then that is a proper investment, or that will justify your investment. It deals with what is called uncertainty domains. From this definition, the importance of time and future arises, as they are the two important elements in investment. Hence, the information that may help shape up a vision about the levels of certainty in the status of investment in future is significant. From an economic perspective, investment and savings are different. Savings is known as the total earnings that are not spent on consumption, whether invested to achieve higher returns or not. So, savings is different and investment is different. Savings is the money that you don't spend out of your income for your current needs and you keep it aside, then that becomes your savings. But that savings does not become an investment until you put that savings into some investment vehicle. I hope you're able to understand the concept of what is income, what is savings, and what is investment. So consumption is defined as one's total expenditure on goods and services that are used to satisfy his needs during a particular period. The values of investment or savings as well as consumption can be determined at the macroeconomic level or at the individual level through different statistical methods. Now, why do we invest? As we discussed previously, that investment is done based on the perspective or what the investor wants as the objective. For example, when you're not earning great amount of money and you want to put your money to good use, you think that I may spend my money. Why not I put the money uh, for some safety reasons? So you put your money into uh, recurring deposit account with a bank, or you put your money into FDs, fixed deposits, so that whenever there is a need of money, you can get your money. So from the point of view of safety, that it is not spent by you on your unnecessary things, or it may be just a second. So from that point of view, your objective of investment will be safety. For someone who has a future goal in mind, suppose for example, if someone wants to buy a car after 5 years or a house after 10 years, that kind of big goal is there. For example, your parent years back must have thought that in future your marriage is supposed to be uh, done. So for that, your parents will need a lot of money. So for that, if they have bought an LIC policy, or they've put their money for a lot of growth, for your education, for your marriage. So that can be another objective of investment, right? Then if someone thinks that want to get a regular income or want to get additional income with the investment done, then you can go with buying some shares of the company or debentures of the company, wherein you can get regular returns in terms of dividend or interest. Then tax exemptions. So if you want tax exemptions, then also investments are done. For instance, uh, you have already studied in taxation salary chapter, or maybe total income chapter, or calculation of income tax. In that, we have seen various deductions under section 80. For example, section 80C gives you a deduction of 1,50,000 if you're putting your money up to 1,50,000. In the recent 4 5 years, it has been 1,50,000 stable. Section 80C. So if you put 1,50,000 in some investing or use for good investment purpose, putting your money in PPF or buying a house, or maybe having an LIC policy premium. So all these things will be part of tax exemption under 80C, and thereby you don't have to pay any tax on this investment done. So investment may also be done for the purpose of tax exemptions. And for liquidity, you always want liquidity associated with your in money, that as and when the need arises, you can get your money back. So you can just put your money into savings account, though you'll not receive a lot of uh, you know interest on savings account or something like that, but still it will provide you liquidity. You can get your money as per your need. So depending on your investment objectives, you can decide various investment vehicles in which you can keep your money in. So how to decide, or what is the process of making an investment decision? Suppose you have money, you have 5 lakh rupees and you want to decide, you want to invest in some securities, then how you will decide? So first you need to, when you have money, as I discussed previously, before investing you should have enough savings, and savings for the purpose of investment. So if you have that, then you can start with the process of investment decision. So first you need to decide the objectives. We have seen all these objectives so far. So depending on your objective, you need to decide what are the vehicles that will suit your objectives. So defining the investment objectives, and then deciding, analyzing the securities where to put your money in. And it is always recommended, you must have heard many a times, do not put your eggs into one basket, isn't it? So you're not supposed to keep all the money that you have in just one of the investment vehicle. Always try to diversify your investment portfolio. So for that, what you need to do, understand securities. So what you need to do, you need to judge the risk and return factors of all the investment vehicles. That is called analyzing the securities. Then construct a portfolio, that how you can put your money, different options. Suppose I want to invest 5 lakhs, then I can go with I going for 2 lakhs in savings, 1 lakhs in 1 lakh rupees in say fixed deposit, 1 lakh in debentures, and 1 lakh in shares. So how much return I get, and what is the risk associated with my portfolio? These are the another way, another investor will think, why not go for putting a lot of money in shares or mutual funds, right? So he'll go for 3 lakhs in mutual funds, and 2 lakhs in the form of FD. So these are different ways of constructing your portfolio. Depending on your objective, you can decide what kind of portfolio you should create, what are the various investment vehicles you should consider while putting your money into it. So you decide, you construct various portfolios, then evaluate the performance of portfolio. So before you actually uh, put your money into any of these investment vehicles, think about, if I select the first investment portfolio, how much return I get, what is the risk associated with it. If I select the second portfolio, how much I'll get return on it. That is called the review of the portfolio. So you need to review it, and then you need to finally make the decisions on putting your money into that particular portfolio, wherein you select various investment vehicles, and you put your money as per your objectives. The higher the particular objective, the more likely you are to put money that satisfies that objective. I hope you are able to understand the concept, how you decide your investment. Moving on. Now, just while discussing the process of investment decision, I spoke about two words, that is risk and return. So what do you mean by risk and return? Any rational investor, before investing his or her investable wealth in the stock, analysis the risk, analyzes, it should be analyzes the risk associated with the particular stock. So you cannot just put your money into any of the investment vehicles. You need to always, you know, access or assess the risk associated with that particular investment vehicle. The actual return he receives from a stock may vary from his expected return, and is expressed in the variability of return. So risk is, uh, h- what will happen to your investment money, how uh, it will depreciate, or it will get affected, the value of your investment will reduce. That is the risk. And return is, how much return do you expect that you will get on a particular investment. So these are the two factors you need to always consider when you think about putting your money into any investment. So let us talk about risk. The dictionary meaning of risk is the possibility of loss or injury. The risk, the possibility of not getting the unexpected return. Okay. So in terms of normal day to day usage of the word risk, we say risk is the possibility of loss or injury. But when it comes to investment, it is the possibility of not getting the expected return. What you expected as a return, you if you don't get, then that is the risk associated with that investment. The deferred return is called the risk in investment. If there is a difference in your expectations and the actual return that you get on investment, then that is called the risk associated with the investment. So investment situation may be a high risk, a medium risk, or a low risk investment. Hence, between expected return and the actual return that you get. So when you buy government securities, uh, you know a particular percentage of return you will get, and you will definitely get it. So that is a low risk investment. And when you're buying shares of a profit making existing company that is making profit continuously, then that is a medium risk. That obviously, as per the trend, you expect that the company will keep making the profits, and thereby there is a medium risk associated with putting your money into that company. But think about buying shares of a new company about which you don't have any idea whether it will be a successful one, or it will not be able to get the kind of return you expect to get from that company. So in that case, buying shares of that company is a high risk situation, high risk investment. So basically, depending on your expectation, if you keep expectation and those expectation has high chances of uh, getting reality, that those expectation, then that is low risk. And if there are less chances that your expectations will be fulfilled, then that is a high risk situation. Clear the relationship between risk and return, one of the important topics of this chapter, understanding the relationship between risk and the return associated with the investment. What are the types of risks? The first one is systematic risk. So what do you mean by systematic risk? A systematic risk is caused by factors external to the particular company and uncontrollable by the company. The systematic risk affects the market as a whole. Now, when I say the COVID has impacted the performance of majority of the companies, majority of the businesses, then the dividends are not up to the level expected by the investors, then what kind of risk can you associate COVID-19? It's a systematic risk. It is something that is uncontrollable by the company. It is something caused by the external factors, and systematic risks are something that you cannot plan for as an investor. They may happen for any reason, and no one has any control over it. But then comes unsystematic risk. In case of unsystematic risk, the factors are specific, unique, and related to the particular industry or a company. So these things you can predict, and that is not that is not associated with the entire market or entire economy. That is associated to one particular industry or one particular company. So they become unsystematic, right? That is happening only in specific area. So that's why it is called unsystematic risk. Sources of risk. How does risk arise? How Now basically it says How do you not get your expected return? Or what are the reasons of not getting expected returns on your investment? So that is called sources of risk. So first is interest rate risk. Now you know how the variations, I mean, in the recent times, the interest rates have reduced drastically. So if someone has put the money in FD expecting a 7% or a 8 percentage interest on the money that is saved, then in recent times when the interest rate is decreasing day by day, right, you cannot expect much of the return, or you are bound to face the risk of interest rate fluctuation. So interest rate risk is the variation in the single period rates of return caused by the fluctuation in the market interest rate. Most commonly, the interest rate risk affects the debt securities like bond, debentures, etc. So you are bound to be affected with the interest rate risk. Then comes market risk. Jack Clark Francis has defined market risk as that portion of total variability of return caused by the alternative forces of bull and bear market. This is a type of systematic risk that affects share market price of and shares move up and down consistently for some period of time. So these are called the uh, systematic risk associated with the market. So that is why it is called market risk. You can never predict the market. You know, whenever the ads related to shares or mutual funds are shown on television, then they always say uh, mutual fund investment are subject to which risk? They say it is subject to market risk, and market risk is always unpredictable, right? So depending on what the market has to offer, it will affect your investment. So that is why it is a systematic risk, market risk. Then comes purchasing power risk. Another type of systematic risk is the purchasing power risk. It refers to variations in the investor return caused by uh, inflation. Okay, you just see the prices of petrol in the recent days. I mean, recent few days, few months, it is going up, and because of it, it is affecting so many commodities that overall purchasing power has reduced. A person who was earning 10 15,000 a year back was able to manage the family, but in after COVID, that money is not enough considering the reduction in the purchasing power. The inflation has increased, and because of inflation, the purchasing power has decreased. Okay. Then comes business risk. Every company operates within a particular operating environment. An operating environment comprises both internal environment with the firm and the external environment outside the firm. So business risk is thus a function of the operating conditions faced by the company, and is the variability in the operating income caused by the operating conditions of the company. I hope all of you are listening to me and understanding what we are discussing. Everyone, all right, great. Next is financial risk. So it refers to the variability of the income to the equity capital due to the debt capital. I think you have studied in one of the topics of financial management, financial risk and operating risk. Have you studied in financial management subject? This particular risk, financial risk and operating risk. So financial risk is basically refers to variability of income to the equity capital due to the debt capital. And financial risk in a company is associated with the capital structure of the company. The debt in the capital structure creates fixed payments in the form of interest. This creates more variability in the earnings per share available to equity shareholders. This variability of return is called financial risk, and it, it is a type of unsystematic risk. It is basically controlled by the company's capital structure. So that's why it becomes the unsystematic risk. Now we talk about the return. So the major objective of an investment is to earn and maximize the return. So we have talked a lot about risk so far, that when you are not able to achieve what you expected as a return and you don't get that return, then that is a risk. So here, when we are talking about return, is something that we want, and everyone wants the maximum. Obviously, you'll always want maximum return on your investment. So the major objective in investment is to earn and maximize the return. And return on investment may be because of income, capital appreciation, or a positive hedge against inflation. Income is either interest on bonds or debentures, dividend on equity, etc. So the rate of return is the return on investment for a period is calculated as follows. So rate of return is equal to annual income plus ending price minus beginning price. Okay. For example, Ajay brought a share of a company for rupees 140 from the market on 1/6 2012. The company paid dividend of rupees 8 per share. Later, Ajay sold a share at 160. So rate of return is 8 rupees plus the difference between 160 minus 140 in 200. So that is 20%. Okay. So this is how return is calculated. Now we talk about the classification of investment. So I'm talking right from the beginning regarding various investment vehicles. So basically, these these are nothing but the classification, how you can or where you can put your money into. So investment classification differ according to their objectives. Classification based on the time standard is the most important uh, one. I mean, you can diversify, you can classify investment into the basis of the time for which you are putting your money into. That is one of the ways of classifying the investment. Therefore the market where short-term investment instrument are traded and has a maturity of less than 1 year is called the money market. And on the other hand, a market with the investment instrument that has a maturity of more than 1 year are called the capital market. So debt instrument, deposits, and other banknotes which have terms of 1 year or less are considered one of the investment instruments in the money market. Shares, however, are considered one of the capital market instruments because they do not have a specific term. Fine. What are the factors that affect the investment decisions? That is the question I gave you for the assignment. Factors affecting the value of investment or factors affecting a company's shares. So basically, it talks about when you should make the investment decision or when you should buy or when you should sell. Depending on those factors, you have to decide on your investment. Okay. So I'm giving you a break for 5 minutes and then we will continue. All right, let us continue with the factors affecting the investment decisions. So, investment is expenditure on capital goods. Basically, you're putting your money into the in securities and asset classes, which are also called capital goods. For example, buying new machines, offices, new technology. But investment is a component of aggregate demand and also influences the capital stock and productive capacity of the economy. So, investment levels are influenced by the interest rates, that is the cost of borrowing, economic growth that decides the demand of in the market, then the confidence and expectations of the other investors that also affects your investment decision. Technological developments and availability of finance from banks also affect the investment decisions, and there are still other factors like depreciation, wage cost, inflation, government policy. All these also affect your investment decisions. So basically, if you see, these are the five major factors that affect the overall investment decisions. So first is economic growth, the interest rates prevailing, confidence or the mindset of the investors, the technology, level of technology, state of technology in the economy, and the availability of finance. These are major five factors that affect the investment decision. Let us try to understand them in detail. First is interest rates. So investment is financed either out of current savings or by borrowings. Therefore, investment is strongly influenced by interest rates. High interest rates make it more expensive to borrow, and high interest rates also give a better rate of return from keeping money in the bank. With higher interest rates, investment has a higher opportunity cost because you lose out the interest payments. So when you have higher interest rates, that basically it leads to uh, no, uh, playing lower. Just a second. Sorry for the disturbance. Actually, this is the time when my son sleeps, but it is obvious that I am taking lecture, so he's not going to sleep. He's playing around and making noise. So sorry for all the disturbances. Okay, so when the higher interest rates are prevailing in the market, then uh, it's the higher opportunity cost that is associated. So you have to be very careful while you put your money into any other investment options, because your existing simple risk-free investment options will give you good return. So you need to be very careful. The marginal efficiency of capital states that for investment to be worthwhile, it needs to give higher rate of return than the interest rate. Now that is a something that you need to keep in your mind when you think about investing. That your cu- whatever current interest rate is prevailing, and if you want to put your money and you want to earn good interest, then make sure that you're putting into an investment vehicle your money, which gives you higher returns as compared to the prevailing interest rate, and that is logical. I mean, you don't want to do a business at 5% rate of, I mean, a business which gives you a rate of return of 5%, wherein your FD will give you 6 or 7% interest if it is prevailing in that point of time. So it is better to put your money rather than doing all the business and taking all the initiatives. It is better to keep your money safe in your bank account, and you can get better return. So that is quite logical. That whenever you make an investment decision, make sure you put your money into an asset, into an investment vehicle, which gives you higher interest than the prevailing interest rate in the market. If the interest rate are 5% and an investment project needs to give a rate of return of at least 5% or more, as interest rates rise, fewer investment projects will be profitable. If interest rates are cut, then more investment projects will be worthwhile. For example, in the current situation when the interest rates are getting lower and lower, in that case it is always advisable that you can think about other investment projects which will give you better interest rate as compared to the interest rate prevailing in the market. Okay, moving on. The next factor that affects the investment decision is the economic growth. So firms invest to meet future demand. If the demand is falling, then firms will cut back on investment. If economic prospects improve, then firms will increase investment as they expect future demand to rise. So now this is again quite prevalent in the recent year or so after the inception of COVID-19. There is a lesser demand in terms of various commodities. So the economic growth is uh, stable in recent days, but it was not that great. I mean, the GDP was falling, it was negative. But then if that is the trend going on, then it is quite obvious that no one is going to demand money, and so there is a less demand or less options of investment available. There is a strong empirical evidence that investment is cyclical. In a recession, investment falls, and as the economy recovers, and it will also recover with the economic growth, the investment also recover. So there's the accelerator theory. The accelerator theory states that investment depends on the rate of change of economic growth. In other words, if the rate of economic growth increases from 1.5% a year to 2.5% a year, then this increase in the growth rate will cause an increase in the investment spending as the economy is on an upturn. So the accelerator theory states that investment is highly dependent on the economic cycle. So the more the economy is in the growth phase, the higher will be the investment options and higher will be the investments done in an economy. So economic factor also affects the economic investment decisions. Then the confidence. Investment is riskier than saving. As we know, savings is always having at least what you have on your hand. But when you do investment, then there are chances that you may even lose what you have in your hand. So, investment is riskier than savings. Firms will only invest if they are confident about future costs, demand, and economic prospects. Keynes referred to the animal spirits of businessmen as a key determinant of investment. Keynes noted that confidence wasn't always rational. Confidence will be affected by economic growth and interest rates, but also the general economic and political climate. If there is uncertainty, example political turmoil, then firms may cut back on investment decisions as they wait to see how event unfold. So confidence, see, if you have followed stock exchange over the years, or if you know something about stock exchange, eh, the entire stock exchange works on the confidence or how the mindset of the uh, in general, what is the mindset in the economy. For example, at the start of pandemic, as it started in various countries, it brought a negative mindset, and so the market started falling. Right, suddenly something good happens. The vaccination was found. The people felt that okay, it's good now. The pandemic will go away, and there was a confidence again. It was a good mood that was brought into the mindset. Then again, the confidence was brought back, into the investors, and so again the market started going up. So this confidence affects a lot of investment decisions in the market. Okay, the notion that is prevailing currently. Then the inflation. So in the long term, inflation rates can have an influence on investment. High and variable inflation tends to create more uncertainty and confusion, with uncertainties over future cost of investment. So currently, uh, investment options are quite a lot, but people hesitate to invest because they don't know how the future is going to unfold in terms of inflation. Obviously, the inflation is on a rise in India, but you don't know how it is going to unfold in the upcoming months and years. So there is uncertainty prevailing, and that is going to affect the investment. If you see the investment options, you get good options now because uh, there's a lot of money in the economy, but people are avoiding putting their money into investment. They just rather are happy to put their money in the form of savings. That is because of inflation. If inflation is high and volatile, firms will be uncertain at the final cost of investment. They may also fear high inflation could lead to economic uncertainty and future downturn. Countries with a prolonged period of low and stable inflation have often experienced higher rates of investments. So the lower and the stable inflation will always lead to higher rates of investments. Okay. And the next factor that affects the investment decision is the productivity of capital. Long term changes in technology can influence the attractiveness of investment. In the late 19th century, new technologies such as Bessemer steel and improved steam engines meant firms had a strong incentive to invest in this new technology because it was much more efficient than the previous technology. So, technology also uh, encourages the investment. So, if there is a slowdown in the rate of technological progress, the firms will cut back investment as there are lower returns on the investment. Then comes the availability of finance. How much finance is available? For example, in the recent years, there's a lot of easy availability of finance in terms of housings are concerned. So people are now putting their money in buying houses, whether they want to live in that house or they are just buying it for the sake of investment. But availability of finance also affects the kind of investment you do in an economy. So in the credit crunch of 2008, many banks were short of liquidity, so had to cut back lending. Banks were very reluctant to lend to firms for investment. Therefore, despite record low interest rates, firms were unable to borrow for investment despite firms wishing to do that. Another factor that can influence investment in the long term is the level of savings. A high level of savings enables more resources so to be used for investment. With high deposits, banks are able to lend more. And if the level of savings in the economy falls, then it limits to the amounts of funds that can be uh, channeled into investment. Clear all of you what we have discussed so far? Then comes wage cost. The wage cost also affects the investment decisions. If wage costs are rising rapidly, it may create an incentive for a firm to try and boost labor productivity through investing in the capital stock or bringing in more machinery instead of the labor. So, in a period of low wage growth, firms may be more inclined to use more inclined to use more labor intensive production methods. So if the production requires labor intense, I mean, if the wage rates are low, then it is better to go with the labor intensive production method that does not encourage investment. But when you have high wage rates, then it leads to creation or buying new machinery that will lead to opportunities of investment into a business. Then comes depreciation. Not all investment is driven by the economic cycle. Some investment is necessary to replace or worn out or outdated equipment. Also, investment may be required for the standard growth of a firm. In a recession, investment will fall sharply, but not completely. Firms may continue with the projects already started, and after a time, they may have to invest in the less ambiguous projects. Less ambitious projects. Also, even in recessions, some firms may wish to invest or start up. The next is public sector. So, in all, there are basically 10 factors that affect your decision. So, public sector investment, the majority of investment is driven by the by the private sector, but investment also includes public sector investment like government spending on infrastructure, schools, hospitals, and transports. So these all also affect the flow of money in an economy and ultimately affects the investment. Then the government policies. Some government regulations can make investment more difficult. For example, strict planning legislation can discourage investment. On the other hand, government subsidies, tax breaks can encourage investment. In China and Korea, the government has often implicitly supported the cost of investment. This has led to greater investment, though it can also affect the quality of investment as there is less incentive to make sure the investment has a strong rate of return. So these were the points that I wanted to discuss with you in terms of the mechanics of investment.